Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Tom, thanks for taking some time to join me in the Australian Investors Podcast, mate.
That's a pleasure, Owen.
It's funny how this conversation came to be. I think I was chatting to my co-host on the show, and Nanuk got brought up, and your name got brought up, and then the stars aligned, and we were able to have this chat. You're dialing in from Brisbane today. I'm in Melbourne. So recording remote, but it's recorded in video. If you are interested in watching the video, I know a lot of our listeners do prefer video, so jump onto the Rask YouTube channel and you'll be able to watch. Mate, we usually start off with a bit of an icebreaker, a bit of tongue-in-cheek type questions. And normally when I ask this question, the person that I ask hasn't achieved probably like a world standing in a skill or something like this, but you have. So I'm going to ask the question, but I'm going to ask maybe not to mention sailing, maybe one thing that you expertise in, or some skill, or I don't know, maybe it's a hobby you're working on which you want to be better at. Just one thing that you wish you could do better.
There's lots of things I wish I could do better. I mean, from the list that you threw out, I wish I could remember things better. I mean, that I have a terrible memory for names, and I don't have great recall of information, which might surprise a lot of people. I'm an engineer by training, and generally sort of do well at things where I can get a holistic understanding of how things work. But often that gets misinterpreted as a good memory for everything, and I that'd be a great skill to have. Things that don't relate so much to the investment. I wish I could, play music and entertain. And I was having a conversation with a friend the other day, watching someone performing and thinking, just that'd be a wonderful skill to have, but way beyond my skill set.
Well, I think as an engineer, we kind of we focus on the science and that framework which you just mentioned there for analyzing problems, and we can make do. But then looking at the creative side, it's probably a little bit, for a lot of us, it's a little bit later in life where we think, damn, I wish I did that. Or I wish I learned to play the piano or do something like some type of creative skill. My second question is actually a two-parter, and it's, what's the best investing book you've read, and then also what's the worst? I think that might bring up some interesting ideas.
Yeah, look, I find it very hard to go past Buffett's Shareholder Letters, which was really the first investing book. It's not not necessarily a book. It's published as as a compendium of those letters if people want to get hold of it. But that's a remarkable sort of resource for people who are new to investing and want to sort of understand at a very deep level what it's all about. But the information's conveyed in such a beautifully elegant way. So that was the first sort of investing text I read, and I think it's absolutely fantastic resource. The one that sort of stands out to me as being really interesting was a book called The Misbehavior of Markets by Benoit Mandelbrot, who's the guy famous for work in fractals, that talks about risk in investment markets in a way that's quite different from conventional sort of normal statistical distributions. And it's not, it's by no means an answer to how people should think about risk in markets, but it's a very interesting book that sort of confronts some of the real shortcomings in mainstream investment thinking. Look, I don't really have a worst investment book to point to. As a general thought, I think certainly the way that we invest, it's very important to consider how other people think about things. And if you're reading investment books, a wide range of investment books, you'll get a wide range of different views, and that's reflecting the wide range of different views of people participating in equity markets. So I don't think there's any downside. At the end of the day, you've got to form your own set of views and your own way of thinking about things, and there's no real right or wrong answers about how to invest. There's some great rules of thumb that have been proven by successful investors over time, but there are lots of ways of participating successfully in investment markets. There's not a right way or a wrong way.
No, I like that. Very diplomatic as well, mate. I probably, it's hard to pick up a book and say it's the worst one that we've come across. One day someone will answer it and they'll raise a few eyebrows, I'm sure. Another one, which is probably more related to the investment process that you follow, which is, I'm interested to know if there's like a global standard for a company that reports like triple bottom line. It's talking about all the right things and it's presenting the information in a really helpful and relevant way for investors. As if there's like a company that you've come across when you're reading the annual reports or 10Ks or whatever, and you think, well, this is an exemplar of how to convey messages to all stakeholders across a business.
I got the question in advance and I still don't have a good answer. I can't think of a company that does represent that at the moment. And that's partly because we don't, in what we do, try to invest in companies who are delivering a triple bottom line as the sort of criteria for investing. But yeah, increasingly companies around the world are starting to address social and environmental outcomes of their operations. And there's companies like Microsoft who are providing extremely comprehensive reporting these days, and not just doing that, but taking active steps to address social and environmental impact, and not just in real time today and for the future, but even addressing environmental impacts from the past. And so I think there's lots of examples of companies that are adopting very encouraging strategies around that, and it's what the companies are doing more so than how they're reporting that's important.
I think that's I think we're starting to see, obviously the tech companies have been able to lead from the front, capital light business models, and they're pretty forward thinking. A company here in Australia, or say New Zealand, is I've talked about a lot on the show, which is Xero, have adopted a new reporting framework, and it's really interesting to see how they disclose some of those softer metrics and how they're evolving over time. And I think it's a good thing. I think we're getting a more holistic picture of business and industries, and even like you mentioned, Microsoft, Amazon to an extent, but also Alphabet has made a pretty bold stance on how it conveys messages and where it wants to go from an environmental perspective, at least. One final question before we get into a bit more about you is, I think like the kind of the active emission in investing is actually a really interesting one. So basically, like, what investment did you not make throughout your career, and what have you learned from not making that investment?
Look, I don't know if it's a tongue-in-cheek response to you, but if I'd left school at 16 and started investing in coastal property in Victoria, I'd have succeeded, as an investor and financially in a way that, orders of magnitude more than I have, having worked pretty hard at my career for 20 or 30 years. Sometimes I wonder if, that was the great missed opportunity. And I think the lesson from that is that, a lot of what proved to be very good investments over time, in hindsight, appear to be very obvious things, and were obvious things at the time. And I don't think you should sort of dismiss investments on the basis that they're obvious, because whilst there's a risk that if something's obvious, everyone's onto it and it's priced properly by the market. In a lot of cases, that's not the case. It's, that there are a set of long-term trends that are very favorable for a particular asset or asset class. And, you're right to position into that. Yeah. And look, I can think of, dozens of, opportunities in the listed markets that we've missed. It's sort of part and parcel of what we do, that you're always going to miss a lot of opportunities. And there are different reasons for different ones. At the end of the day, most of it's about having confidence to act and a willingness to, be wrong within your portfolio, or an appetite for being wrong, or being wrong for a while before you prove right. That's the reason for not acting on them.
That's actually I did not expect you to say property, and I did not expect you to identify Victorian coastal property. But
yeah, look, I grew up in Victoria, and as a kid in the late 70s and early 80s, if you went to coastal towns in Victoria, you could buy bits of land today that are worth hundreds of times what they were then, and it wasn't, such a stretch to think that, you were going to see a huge amount of development over a long period of time in those sorts of areas, and a lot of people have done extraordinarily well out of that. Good on them.
Yeah, good on them. And I think we'll get to this throughout the conversation. I think it'll be a recurring theme, is like the complexity of investing and how it can be simplified. I have shared similar sentiments growing up towards the Yarra Valley, and seeing that development happen as well. So let's zoom in on you a bit, mate. So people may know who you are that listen to this show, but one thing I'm interested in, one thing that I like to understand from investors and professional investors, is basically the threads of investing through their life, and maybe where that journey started. You mentioned that, you grew up in Victoria. Was investing, all of this type of thing, economics, was that part of your childhood? Did you have anyone mentoring you or guiding you down this path?
Unusually, no. I mean, I didn't engage in any serious way with investing in investment markets until I was in my mid-20s. And yeah, I sort of grew up in a family with two parents who were both architects. My grandfather had been a mining engineer and was a very successful business leader within the Australian mining community. But no, my sort of family background didn't provide me a lot of exposure to investment markets, and I studied mechanical engineering at university, and my initial sort of professional career was in engineering and industrial consulting. And it was through a series of sort of, steps in my career that, weren't planned from an early stage, that I ended up in investment, deliberately in the investment industry more broadly, and then progressively moved towards what I'm doing now. Sorry, go on.
I was going to say, so one thing I didn't know is that both you and your wife, if I'm not mistaken, are Olympic gold medalists. Is that correct?
My wife's an Olympian. She was a two-time world champion in rowing.
Yeah, right. And so this, I guess, I don't know a lot of this backstory, Tom, even though I've done a fair bit of prep for the conversation today. So I did know that you got first class honours from Melbourne Uni in engineering before you transitioned across to investing a few years later. But where did sport fit into that, as throughout your childhood? Was that kind of all consuming? I'm guessing it was. And did that come first, or did the interest in engineering come first?
Look, I mean, I grew up in an environment, with engineers and sort of practical hands-on people around me, and I always have had and still do have a great curiosity to understand how things work. It's always been in my thing to pull things apart to understand how they work. And look, I mean, I went through school in Victoria. I was very strong in maths and science, physics and chemistry and things like that. And it was a pretty natural progression for me to move into engineering, where others in my family had done before me. And I never really thought beyond doing that. It was something that I had an innate skill set for and was good at many of the aspects of, and that was an easy sort of choice. The sailing was in parallel with that, so I learned to sail in my early teens and got involved with competitive sailing on Albert Park Lake and involved with the junior sailing program in Victoria. And sort of over time, I wasn't by any stretch a particularly talented young sailor, but I really enjoyed it, and some of my academic skills could be applied in that sporting environment in terms of understanding sails and the wind and how the sport worked, and I really enjoyed that. And as I put more time into it, I got better and better, and it was a long progression from starting at a low level in club sailing to reaching a state and a national level and then competing internationally. And it was something that I was very fortunate to stumble into, where I had I had a love for it. I had a skill set that was relevant to it, and I got a lot of reward for putting effort into it. And in the end, there was always part of me that believed I could be very good at it. And the progression was to go and compete internationally in Olympic classes, which is the pinnacle in the sport of sailing. And I pursued that. And so whilst I was studying engineering, I was also training and competing internationally, and my engineering degree ended up getting spread out over 8 years because I took a chunk of 3 years off to go to the Olympics in '96. And then I finished my degree and took another chunk of time off to train for and compete in the games in Sydney. The plan was always that after the games in Sydney, I would go and get a job in industry as an engineer, and move into the next phase of my life, which is what I did. So I stepped out of the boat at the end of the Sydney Games. I had a job that I'd been offered with an industrial consulting business, and started that job early the next year. And at that stage, my interest in investment really came from the sailing side of things, because sailing the discipline of sailing that I was involved in, which was sort of one design fleet racing, is a sport where you have a large field of competitors sailing identical equipment, and to a large degree, your success depends on making good risk-return judgments on a continual basis. And having succeeded in sailing, I always felt like there was some parallel with investment markets. If you look at a share price chart and you look at a wind direction chart, they look pretty similar. And in sailing, you succeed by positioning yourself in relation to what the wind direction's likely to do in the future, and being more consistently right about that than your peers in a field where everyone else is trying to do the same thing. And I always felt like there had to be some sort of parallel. And so I had this sort of interest in the back of my mind as to can the decision-making frameworks and the skill set that I had in sailing, which was ultimately to be very good at making relatively simple decisions, but in a very complex, dynamic environment under a lot of pressure, be translated into something in the investment space. And I didn't, I didn't start off in the investment world. I started off in investment consulting, in industrial consulting. I worked for a very interesting small business that did manufacturing performance improvement work with large manufacturing businesses. And it was a really interesting and eye-opening thing to do for a short period of time. The company had an almost absurd claim that it could improve the efficiency of any manufacturing process in the world by somewhere between 10 and 40% within 2 to 3 months with no capex. And the firm had an extraordinary track record of being able to do that. And that might sound, ridiculous, but when I saw what was possible inside these businesses, it sort of opened my mind to the ability to, or for pragmatic decision making to make a better world. And the reality is, in a lot of manufacturing businesses, a lot of things are done less than optimally because it's easy to do them less than optimally. And it's not that hard to speed things up if you can solve the problems that you run into when you speed things up. And that's what that firm did. And I had that experience within the first couple of months of working there, of being a, wet behind the ears young consultant with very little skill or experience, but able to, pragmatically solve a couple of problems and deliver, whatever it was, $1 million more output from a production line with no cost. And the problem with the consulting business model is it's very hard to ingrain the kind of skill set and approach that the consultants have within businesses. And what the experience left me with was a sort of perspective that we were doing something extraordinarily valuable that was of huge value to the shareholders of the company that we were working for. And as a firm for that engagement, let's talk in round numbers, we might have been paid $100,000. As a consultant, I was getting $10,000 for that work. The company's profit was going up by $1 million. And on a capitalized basis, the shareholders were benefiting by $10 million. So I'm getting paid $10,000 to deliver $10 million of value to shareholders through making some pretty simple, logical decisions. And what's more, I'm trying to do it as an outsider consultant with a lot of resistance rather than as an insider or as a director and shareholder with real leverage to make things happen on a more permanent basis. And so I had this experience for a brief time in consulting, and it left me thinking, actually, I'd really like to do this work, but in order to really do it properly, to achieve proper change and real benefit for companies and for the for the world more generally to operate more efficiently, I have to be a shareholder, and so I need to be on the investment side of things. And my initial thinking was, right, the natural place for that kind of philosophy and approach would be in private equity, but as a sailor and engineer, my sort of opportunities to get into that initially were pretty limited. But I had an opportunity offered to me to join an Australian equities fund manager, and that was my foot in the door into the investment industry. And I did that, and that's where I started. And once I was there, my investment my real investment education started. And I didn't end up staying in that role for that long. because partly because of the firm that I was in, the role wasn't right for me, but also because I felt like I needed a broader education. It goes back to the way I think and don't remember things. I'm not going to act confidently unless I feel like I have a very good grasp of the big picture. I need to see most of the jigsaw puzzle in order to be able to make decisions. Not an innately overconfident person. And so I went and worked in investment banking, and I worked at Rothschild for 3 years in a range of roles, mostly in sort of corporate finance advisory work, but got exposed to the lending business and to the managed investment scheme business there. And then I left that and worked for Consolidated Press for 3 years in a sort of in a role that was pseudo private equity, sort of involved in managing the large portfolio of unlisted assets that Consolidated Press had at that point in time. And then I had the opportunity to be involved in starting the business that I'm involved in today at Nanuk. And that at that point in time, was an opportunity for me to bring together a lot of the sort of various skills and knowledge I'd built up over time and apply it to something that I was sort of passionate about. So, to an opportunity set that I was absolutely convinced was going to last at least the rest of my investment career. And was doing something in the investment space that had, to some degree, a higher purpose to it.
Mm. There's so much that we need to pull on there. So many anecdotes that you gave us that I feel are really interesting. But can I ask, why is it called Nanuk? Or Nanuk?
Because it's very hard to find, a short name for an investment management business that hasn't been used somewhere in the world before. Agonizingly difficult thing to do. We ended up with Nanuk. Nanuk's the Inuit word for polar bear, because that, was a symbol of, environmental and particularly climate change issues that we thought was appropriate to our business.
Okay, I've got a few things that I want to loop in, and I'm going to do these out of order, so apologies in advance, mate. You mentioned before that as a consultant on the engineering side, you could see things that needed to be changed or could be changed, but from the outside, it was probably more difficult than if you actually had some keys, like a way to be, influencing the board or the senior engineer or something that within the firm. One of the conversations that I had, and I had a debate with a guy called Scott Phillips, who was an old colleague of mine at the Motley Fool. And we debated about kind of like ESG, responsible investing, and all of this sort of stuff. And the perspective was that, do you have more influence from the inside or from the outside? So what I mean by that is, as a shareholder, say in public companies, a lot of the frameworks that people adopt, maybe if it's like through a passive fund or something like that, they just exclusion, they use those negative screens. But his perspective was, well, maybe you should buy the ones that aren't necessarily air quotes, sustainable businesses, and try to influence that business from by being a shareholder. And your experience was different to that because you weren't going at it from that lens, more from the efficiency perspective. But in your opinion, what do you think is more impactful on changing these companies, whether it's culture, whether it's efficiency, whether it's climate? What do you think is more efficient from an investment, but also from a responsibility perspective?
Depends on what problem you're trying to solve for, and you've opened up a big can of worms there, or several cans of worms. Look, I think if you want to improve the performance of businesses, that's a management and culture issue. That's where that kind of change has to come from to be real and sustainable. But you've sort of asked about what's the role of shareholders in all of this, and I guess I'd sort of comment on a couple of things. One, shareholders in listed markets, sort of buying and selling shares in the secondary market, have almost no influence, and that might, surprise you to hear that coming from someone who runs a fund that other people point to as an ESG fund. But the reality is it doesn't change the ownership structure. It doesn't change the the board. It doesn't change the price in any meaningful way. Maybe at the absolute margin, you're affecting cost of capital, but in reality that it's not to a degree that's likely to be making any difference to anyone. So I don't think it's right to think that just by allocating capital to investment in the secondary market, you're making a difference. I do think that the collective voice of shareholders is very important. So as a shareholder or as a fund manager, representing the investments of our clients in companies, we still don't have much of a voice. We can. It would be wrong to think that our actions alone are likely to make any difference to management or board decisions at any of our investee companies. But it's also extremely important that we do voice those things, because it's the collective voice of investors that will be heard. And we do see it as sort of an important part of what we do, that we articulate our views about issues related to sustainability and the environment and governance and so on, clearly, in the expectation that others will be doing the same. And when that message is being heard from a lot of people, it will start to have some impact. But the piece that I think is missing is that when you want to talk about environmental issues, there's not enough discussion about the role of government. And my view is very strongly that a lot of people are expecting investors and companies to solve problems that are really government problems to solve. We have an extraordinary economic system that is, in aggregate, very good at allocating resources well and coming up with the solutions we need in the economy. But it operates in a set of rules, and what it will deliver is dictated by the rules and the guidelines and the pathway that are set by government. And for whatever reason, people don't seem to recognise that we have a quite extraordinary financial system that exists in the structure it does because governments have defined very clearly how it should operate to deliver what governments want it to do. And same can be said about the healthcare system. They are extraordinarily different in structure to what they would be if they were largely unregulated and was left to the industries to decide how they operated. And in respect of environmental issues, the same applies. If governments are very clear about where society wants us to end up in terms of environmental outcomes and sets the rules for corporates to operate in, the corporates will do a great job of operating within that framework. And ultimately, that's where our environmental problems will be solved. It's not going to be solved by the voice of shareholders or by good thinking corporate citizens within companies making great decisions for the environment. It's going to be solved by the government setting the right pathway and then companies being able to act clearly within that. And if I think about our firm and where our potential impact is as a firm, it's in helping create better debate to have better decisions made by governments going forward. And being good at investing is our is the basis on which we'll be allowed to participate in those conversations. We're not going to change the world by the way we invest. We will help change the world in a meaningful way if we're good at what we do. We build a larger, more successful business, and we can start participating in a meaningful way with the people who set government policy to make those kind of changes. And you sort of raise another issue, which is this issue of should you invest in bad companies and help change them, or good companies, I guess it sort of opens up a couple of topics, right? One is, what is ESG, right? What is ESG investment? How should it be done? And the second is this challenge of a lot of ESG or responsible investment of trying to balance different outcomes alongside investment outcomes. And on the first of those, I mean, we can talk more sort of about this if you want to, but
for sure,
there's a massive problem in the investment industry today with ESG being used as a term that people often think has a single meaning, and it doesn't. It's an acronym that doesn't have a meaning at all, and it's used by different people in different contexts to refer to a whole range of different approaches or facets of responsible investment or ESG integration. And there are sort of 5 or 6 or 7 quite discrete elements of ESG or responsible investment that need to be thought of separately. And that's a big problem for the industry at the moment. I think you're moving over, at a slow cadence towards people starting to recognize that and to, acknowledge that investing in bad companies and helping make them better is a valid strategy, just as investing in good companies for the benefits that might come from doing that is an equally valid strategy. They're totally incompatible, but nothing's wrong with either of them, and they're both good, but you can't pretend they're the same thing or fall under the same bucket. You can't measure them in the same way, and people need to be really clear if they're talking about ESG about what is it they actually want. And then the other issues around performance and whether there's a performance trade-off in achieving environmental and social outcomes. And absolutely there can be. But look, the big problem is if you start to set multiple goals, you end up with suboptimal outcomes, right? It's almost by definition, right? That you can't be simultaneously optimizing investment risk and return outcomes and optimizing environmental and social outcomes. And to pretend to try and do both of those things at the same time is nonsense, right? So I think there's nothing wrong with pursuing environmental and social outcomes, and it's a perfectly valid thing for people to do if that's what their priority is. But it shouldn't be conflated with that is the right way to optimize for investment returns.
We did a survey not too long ago of our community, Tom, and we found that many of our members and our listeners would be happy to forego alpha and even performance in order to achieve goals that they believe were responsible when it comes to investing. Does that surprise you?
No, not at all. Not at all. And I think many of our clients feel that way. Look, there are lots of investors out there for whom ethical considerations are important, and they want to know that their hard-earned capital is not being, deployed for the use of companies doing things that they don't like. There's nothing wrong at all with that view. And there's also nothing wrong with the view that people want to see some or all of their capital deployed into things that are going to make a difference from the world in a non-financial way. That doesn't surprise me at all. I think it's a trend that's only going to increase. It is driving change in the investment industry that those demands do exist.
My other question was more along the lines of, you mentioned government playing such an important role. I have this, I guess, concern that because terms for governments are 4 years, that they have an inability to make very hard decisions for 10 years or 20 years out into the future. Do you share that sentiment, or I guess is that maybe a jumping off point for something that you think about from that perspective in terms of solving problems, but I guess having the myopic nature of voting today and politics today?
Look, I don't think I'd be alone in saying that the caliber of political leaders in this country and in many Western countries doesn't seem to be today what it has been, historically, and that we haven't had a lot of leaders who've been willing to spend their political capital at risk of defeat in future elections for the sake of making good long-term decisions. And that's a problem for democracies around the world to deal with. And we can only hope that it's something of a cyclical thing that'll change. In relation to environmental issues, I think there's a different dynamic going on. The world's environmental issues are becoming much more obvious to people. If you look around the world at what's happened this year, it is profound. Worst drought in Europe in 500 years, 70% of China's rivers running dry, and the worst drought they've had for 100 years. Sydney had its average annual rainfall in the first 3 months of this year. There's a list as long as your arm of things that are or of events that reflect the increasing energy in the Earth's atmosphere and the volatility of meteorological events that scientists have been telling us is going to happen. And I think people are starting to appreciate that we are dangerously close to some pretty serious environmental tipping points, but perhaps more importantly, that the geopolitical consequences of some of that stuff are profoundly bad. And we don't want to see China run out of water, or India run out of water, or Pakistan totally underwater. There is no good to come of any of that. And what's happened politically is pretty interesting. That in the last 4 or 5 years, in a pretty large number of countries around the world, you've reached a point where the sort of climate and environmental issues are the number 1 or 2 issue for voters, in most cases the number 1 issue. And the political parties who've won elections are winning them on the basis of policies addressing those issues. And what's happening is every sort of electoral cycle, and I think you'll see it in this country, another 3 or 4 years of young voters are coming into the electoral pool and will overwhelmingly vote with that being their number 1 issue. And the political balance has tipped. The pendulum's swung past halfway now, and it is not going to swing back. The next federal election in Australia, you're going to have, another 3, years of young voters eligible to vote for whom these environmental issues will be the number 1 issue. And a government's not going to win power on a platform of going back on commitments. They're going to want stronger and stronger commitments. And so I think, we're going in one direction, and we're going to keep going increasingly fast. At the moment, and the COP27 conferences on in Egypt at the moment, and it's no surprise to me to have them coming out saying, well, 1.5 degrees is just not going to happen, right? Realistically, it's not going to happen. And people need to understand that the trajectory of where we're headed is a whole lot worse than that. And governments are going to start, they've taken some extraordinary steps in Europe and in the US, and even the commitments we've made in Australia are pretty extraordinary. But those commitments are going to get ratcheted in a really aggressive way in coming years as the, environmental issues continue to worsen, as, becomes clear that the pathway that we're on has untenable geopolitical consequences for us.
I mean, yeah. Okay. So there's so many different directions from here. In respect to, I guess, you mentioned before, like greenwashing is the label that we give to a lot of investment products and consumer products and every product that seems to play on this label of do good for the world, buy this thing, pay a little bit more. And a lot of us don't really know if it works or not, right? And I guess from an investment perspective, I have this view, and I don't know if you'd agree or disagree. And if you disagree, I'd love to know. Like either way, I'd like to know that oftentimes, at least in investment markets, we see euphoria around some type of theme or whatever it may be. Like let's say a more dramatic theme might be cryptocurrency and the rise of Web3, or the 2000s .com boom and bust, or cloud computing, and we see kind of like whipsaws around, and you have these excesses, and then you have these, I guess, kind of famines in investment markets, if you like. And out of that, like we on the way up, we say how great is this, on the way down, we think it's the worst thing ever. But oftentimes the result of those swings is that you have really interesting things that might not have happened otherwise. So where I'm going with this, Tom, is, we mentioned before that maybe as individual investors and just buying shares in quote unquote green companies or whatever might not have the impact from like a downstream pushing up to decision makers. But I guess if we do have more of a focus on it as investors, does that, through osmosis eventually like creep into the investment zeitgeist, and we start to see more companies with shareholders who maybe they're passive, like maybe they're just on the register and they don't think they have a say, but it kind of tends to trickle in and seep into what the decision makers are thinking. And I guess because you run a fund, right, that takes into account all of these things, and you say that investing is like a kind of like the part of the impact you're going to make. But I feel like we should still be investing this way nonetheless, because it, at least philosophically, if we do care about these things, it would make sense. I don't know if this is a question or it's a statement, but do you kind of get where I'm going? Like, it's still like, how do we still have an impact if we're investing in public equities?
Look, I don't think there's any benefit to you or anyone else other than the people you buy the shares from. If you buy shares in companies, involved in more sustainable activities at elevated prices that the companies are never going to, deliver the profits to justify. I don't think that does you any good. I don't think it helps the world. I mean, the kind of cycles that you're talking about are very important in what we do, and we've just been through one, very extreme one in the last couple of years, where changes made to government policy or expectations of changes to government policy and government support for a wide range of sustainable technology have led investors to pile into a relatively small set of stocks in niche parts of the economy. And simply because of supply and demand for shares, the share prices end up rocketing up to very elevated levels and high valuations. And that's a good thing for the world because it attracts more capital into those areas. and more investment in research and development and in capacity expansion and in the development of those technologies. And in doing so, serves the purpose of the policy that caused that to happen. But yeah, buying those things at elevated prices doesn't help you or the world, I don't think.
How about Tom? Say for example, like if we look at venture capital, right? There's a lot of like, it's that's a game of slogging, I guess. It's like you're not about making like single runs. If we have a cricket analogy, it's about hitting sixes and knowing that most of them are going to fail. But I guess the investment in those innovative businesses itself takes innovation forward, right? Even if it doesn't work, there's something that we try and we give it a crack. And I guess, does that analogy apply to what we're talking about here, like decarbonization and those types of things?
It does, but there's a difference between providing new capital via venture capital or private equity or through IPOs and capital raisings and not providing new capital to the companies just by buying shares from other people who own them today. There's a distinct difference in terms of whether your money is new money being invested or whether you're just holding shares in that someone else might have owned. If you want to deploy your money into new investment or new research and development, you probably need to do it through venture capital and private equity or IPOs and things like that, rather than investing in the secondary market.
Okay, so I'm hoping that there's so much I want to talk about here, but one of the things that you mentioned earlier on about sailing was that it's all about risk-adjusted decisions, basically. Like you go this way. I do not know anything about sailing, Tom, so I'm just spitballing here. But you put the sails this way, you try and catch that breeze. There's this wave coming, whatever. It's just micro decisions after micro decisions that some of them are good, some of them are bad. Do you think that investing, in a sense, in this way is best thought of as being a competitive pursuit, or do you think it's more of an individual pursuit? And this is a kind of like, we could say both, but there's so many ways that this answer can go, because I can think of it from like a personal finance perspective and my sleep at night factor, but then I can also think of it as from a context of, well, I want to do better, and that is what makes me a better investor over time.
I mean, the job that I do, professional funds management, is absolutely a competitive business. Our value as an investment manager is determined by whether we do a better job than most of our competitors or not. I don't think there's any debate about that. But I'm not going to pretend to tell people how they should invest. That is a personal thing. And it depends what your objectives are, as you say. I mean, your risk tolerance, your investment outcome objectives, your non-investment related objectives in relation to what you're doing on the investment side of things. And I don't think there's a right or wrong answer to that.
How about then, from your investment process perspective, right, where you make a decision between what is a good investment and what is a company that you want to be involved in? We chatted briefly off air about maybe an example that you had about companies that might illustrate the way you think about these competing problems of, I want to invest in a way that's good for society, good for the environment, and I want to drive investment returns for my clients. I feel like an example can illustrate how those two competing priorities balance.
Yeah, I mean, let me talk about what we do as a firm, because I think that might help understand how I think about it and how we go about it. So we started Nanuk 13 years ago because we thought there was likely to be an enduring investment opportunity set coming out of what was going on globally in terms of ongoing population and economic growth around the world, and a set of pretty evident environmental issues and environmental constraints, climate change being the big one, but not the only one. And very simply, our thesis has always been you can't reconcile those two things with the current sort of economic model globally. That something has to change or a lot has to change over coming decades, because we can't continue to have population and economic growth and to continue to have worsening environmental issues. Something's going to break. And irrespective of how and when it breaks, and how that change happens, the investment implications of that are going to be profound. And you're starting to see that already. You've seen a lot of change in the global economy over the last sort of decade, and you're going to see orders of magnitude more over the next couple of the same nature. And those are important things for investors, because a lot of companies are going to have to change in a way that's probably not going to be helpful to their profitability and their value. And there's going to be a smaller subset of companies that are on the right side of those transitions. And our view's always been that if we could invest successfully within that opportunity set, that we have a very good chance of delivering good investment outcomes for our clients. And that's the primary focus of our business, delivering good investment outcomes from what we think will be an enduring opportunity set that has a set of characteristics that lend themselves to the kind of investment that we do, fundamental research-based, valuation-focused investment, and that we'll continue to have a sort of stream of these opportunities for a long period of time. It's an adjunct to all of that we are investing in companies that are contributing positively towards improving global sustainability. And that's a feature of what we do that some of our clients think is important. Not all of them. A portfolio in the first instance should deliver some alpha and should have a set of holdings that mean that the diversification benefits for our clients are good. And that's reason enough to use a global equity fund, but we're not the only ones who can provide those features to clients. But for a lot of our clients, they're also interested in knowing that some of their money is being invested in companies that are doing things that are going to make the world a better world. We're not necessarily changing the world by making those investments, but people, might feel better, might sleep better at night, whatever, because of that. But yeah, I mean, going back to what we do, we're an investment firm that exists on the basis of an investment thesis, and what we do is trying to make good investment returns for our clients. And there's not a trade-off between trying to invest in companies that are doing more good or less good and trading that off against better investment return or worse investment return. What we do is we define the set of companies that we can invest in around a set of industries and technologies that we think are contributing positively to improving sustainability. Mostly really obvious things that fit that description: renewable energy, energy storage, grid technologies, energy efficiency solutions, sustainable transport solutions, electric vehicles, rail transport, things like waste management, recycling, water treatment, water efficiency. The list goes on. So we've got a list of all these industries, and if companies are materially involved in those areas and not doing things that are badly misaligned with those areas, they'll be in our investment universe. And given that investment universe, which is now about 15% of the broader global market. Our job within that is to pick a portfolio that we think will deliver good risk-adjusted relative returns. And we don't try and produce a portfolio from that set of opportunities that is more impactful or more sustainable or has better ESG scores or anything like that. Our investment decisions are based around our assessment of the relative return potential, the risk-adjusted return potential of each of those stocks. We buy a stock where we think that it's going to generate alpha sufficient to justify the risk we're taking, and we'll sell something when we've got a better opportunity to replace it or that potential no longer exists. And it's not muddied by trying to have a set of dual objectives of, this solar stock's more impactful than this waste management business, and therefore we're going to buy the solar stock over that. If the return potential of the waste management, stock is better and better suited to the portfolio at that point in time, then that's the investment decision we'll make. And I think keeping it simple from our perspective like that is very important, because if you start to try and solve for two problems at once, you're going to start investing in things that aren't the right investment to make if you want to achieve good investment outcomes.
So just to summarize there, Tom, so you're putting basically, you've got your global universe and you put the environmental sustainability type buckets in front of the fundamental.
Yeah, well, yes, we invest exclusively from within a self-selected investment universe that's been positively and negatively screened to only include companies that are materially involved in sustainable technology and industries, and doesn't include companies that are involved to any large degree in areas that are ethically or environmentally problematic. And from within that, we construct a portfolio based on investment merit.
So I'm just going to pull out an example from an article that I read a while ago, which was Daikin. And in that article, in the AFR, this is Daikin, the air conditioner for anyone, like the air conditioning company for anyone that's playing along at home. And in that, it was mentioned that the company also has like a defense element to it. How do you think about companies that say make environmentally efficient products, in this case an air conditioner, but also have some other type of business? Like there's an example in Australia with like Woolworths that also used to have a pokies and hotels business, and there are numerous examples of companies that do multiple different things. How do you think about those businesses and whether they're in that universe or not?
We try and be pragmatic about it, and we also try and accommodate the wishes of our clients, because at the end of the day, what we do is provide a service to our clients. So Daikin, would be eligible for our investment universe because we include companies who are producing energy efficient heating, ventilation and air conditioning systems, and that's what they do. But as well as that positive screen, we also have a negative screen, which excludes companies who are involved in areas that are poorly aligned with our environmental focus. So companies involved in oil and gas exploration and production, in coal-fired power generation, in palm oil production, in areas that are not a good fit with our mandate, as well as a series of areas of ethical concern, because we recognise a number of our investors are sort of ethical investors and want to use the product because our areas of focus by and large don't overlap with things like defence products or gambling or tobacco and alcohol. And that's formalised in this exclusion framework that says we're not going to invest in companies who have any involvement in producing sort of weapons and combat equipment. And unfortunately, Daikin, quite unusually has a very small division that's only about 1% of its revenue that produces missile systems for the Japanese Department of Defense. And we've got a 0% threshold, and that means that we've got to exclude it. It's black and white decision. The interesting thing about that one is it's still held by a lot of ESG type funds who purportedly have restrictions on those kind of things. I think because it's not, you have to read the detail of the annual report or have good ESG data in order to know that it even has that business. It's not made obvious.
Interesting. Yeah, see, I didn't know that either. Reading that write-up in the AFR, but that caught me off guard. So I didn't know that. Just in the interest of time, maybe I might, because you're very uniquely placed as an engineer, but also as a very experienced investor. Maybe this is a quick one for you to answer, and it's for myself and anyone else that is interested in learning more about this as like a sustainable investing, emphasis, and that's what we want to focus on. What, I guess there's multiple questions in this, but how can we, I guess, improve our knowledge of what is, what are the key factors that we should be looking at? There's companies that report emissions targets. There's companies that report scope 1, 2, 3, all these different things. I guess, what are the things that you have, or even resources, Tom, like even, go and read this or look at that. Anything that you can leave us with that might help us form a better view of how to understand companies and their environmental impact. I think that'll be really valuable, not just to myself, but many thousands of listeners who tune
in. Look, as I said to you earlier, I think the whole sort of ESG and responsible investment landscape is still very confused. And I don't think there are great resources out there that are helping people clarify in their own mind what it is they're trying to do. But that's what I'd encourage people to do, to think deeply about what it is that you're actually trying to achieve. And carbon emissions is an interesting example of that. We run a sustainably themed investment fund, but the emissions intensity of our portfolio isn't that different to the broader market. And it's a lot higher than most low carbon funds, which do something quite different. And that's because emissions intensity is measured as scope 1 and scope 2 emissions, and not scope 3 and scope 4 avoided emissions. Because low carbon investment, so investing in companies with inherently low carbon footprints, is a completely different endeavor to investing in decarbonisation solutions. So if you want to invest in a low carbon portfolio, which is a perfectly valid thing to do, and there's lots of good reasons to do that, and it's the strategy that's sort of the low hanging fruit and being adopted by a lot of our large institutional investors in Australia, that will lead you to invest in large financials, technologies, and healthcare stocks, which are companies with inherently low carbon footprints per unit of revenue. And the I guess, carbon emission profile of those businesses is orders of magnitude lower than making lithium batteries or manufacturing electric vehicles or building wind turbines or deploying solar panels or doing waste management or recycling, industrial activities that use energy and have a footprint. I think the important thing for people is to get clear in your own mind. Are you just trying to invest ethically and not invest in companies doing particular things that in your value set are unacceptable? Are you trying to invest in a low carbon manner, which is going to lead you, as I said, to invest in financials, healthcare, and tech companies which may not be a particularly different investment portfolio to not doing that. Are you trying to invest in an activist manner where you're buying bad companies and exercising your position as a shareholder, or with a manager who's doing that for you to see those change in a way that's positive? Are they doing that, for environmental and social reasons, or are they doing that because it's a lever to generate alpha? The different variations of that approach. Are you looking for investments in areas like we focus on, decarbonisation and other environmental solutions that are well aligned with or contributing to improving global sustainability? Are you looking for true impact investing where you can measure social and environmental outcomes? These are all distinctly different things, and that's where people really have to be clear in their own minds, because if you know that, then it's not actually that hard to work out what you can and can't or should and shouldn't be investing in. And there are good investments in all of those areas. And I haven't even touched on ESG and ESG integration, because that's another bucket entirely. Also something that's a meritorious thing to be doing, and can confer investment benefits, but it's not the same thing as the other aspects that I've just described.
I would encourage anyone that's listening or watching to just try and understand at the very basic level the difference between scope 1, 2, 3, and 4 emissions, and just understand how those are reported. Because as Tom's just said, you can end up with financials, tech, and healthcare, but does that address the full ecosystem in which that company operates, or the industry in which that company?
Or at a simpler level, is that
Sorry, go on.
is that leading you to invest in the things that you actually want to be invested in? Is it because it'll preclude you from investing in a wind turbine manufacturer who has an industrial business?
And I think that's the key. A lot of people are kind of, like you said, there's a lot of misunderstanding, or just people that haven't carefully thought, not just, as you said, from their perspective, but also understanding the kind of the different ways we are trying to measure industries and companies and so on and so forth. And once you have just even a basic understanding, you can make a more informed and deliberate decision there around who you invest with or what you invest in. Mate, I might just ask one final question, which is, this is more of a philosophical thing, and it doesn't have to be related in any way to what we just spoke about, but could be. It's more of a question to try and tease out something that you believe that maybe most people might disagree with you on or have not thought about. So what's one thing that you believe about investing, about business, could even be about life itself, that few people would agree with you on?
I've probably given you a few already in this.
Yeah, I've given us plenty.
Look, I mean, in a general sense, I've always believed that it's possible to succeed in business or in other facets of life in an honourable way, by being honourable and respectful and fair to the people you're dealing with. And that's not, I don't think that's a common trait amongst our business leaders, but I do believe that to be the case. And yeah, I mean, if I look back to my sailing career, it's one of the things I'm most proud of, that I think got to the end of that with the respect of our competitors, and we got a result, but we did it in the right way, without bending the rules or stretching the truth or treating people in an unfair way. And I'd like to continue that through my business career. On the investment side, it's interesting. I'm not educated in the same way that a lot of people involved in the industry are. I didn't study accounting or commerce or economics. I trained as an engineer, and I have probably a different way of thinking about a lot of things. much of which has just been born from experience over time and a curiosity about understanding how the world works. I think there's a lot of things in the investment community that are discussed as if they're known or they're black and white, or there's a solid academic foundation to what, or to understanding investment markets and what people are doing in investment markets. And the reality is a lot of, what is held out as the academic truth is stuff that's been, developed in the last few decades. It's not, it's not an area like engineering and science where, the basic laws of physics have been very well understood for hundreds of years. You're dealing with markets and the behavior of participants in markets, and they're not, easily analysed in such a black and white way. And even when you hear about things like valuation, people talk about valuation as if it's a science. And my observation over time, having worked in different environments in quite different contexts, gives me an understanding that valuation is an opinion. It's not a fact. And different people will rightly have different opinions about valuation of the same asset at any point in time. And that's, I don't, things like that, I don't think are commonly held beliefs within the investment world. Look, I think I said it earlier on. I think, part of this game is being true to yourself and developing your own set of beliefs, because there's a lot of different ways that you can be successful in investment markets. There are a lot of different strategies that will deliver good investment outcomes if they're executed well, and there's not a right or wrong way of doing that. We do something that we believe in and think is effective in the effective to deliver the outcomes we're trying to achieve in the area that we're investing. But there are certainly other ways of going about it, other styles, other approaches that could be equally successful at different points in time.
I like it. I particularly like your phrase that valuation is an opinion, not a fact. I think that's a really succinct way to answer that. So I really appreciate you taking some time out to join me on the show, mate. For anyone that wants to learn more, they can head to the Nanuk website. There'll be links in the show notes. Yeah, and I appreciate it. We covered a lot of ground and we kind of went in every direction at every moment. So you handled it really well. And thanks for sharing some of your wisdom.
Yeah, no problem, Owen.